guys, Michael Ketchen here with another episode of the Michael Ketchen Show. As always, joined by Matthew Hitchcock.
How we doing?
And one of my favorite people on the planet, a guy we've done multiple millions of dollars in business together with, Michael Chadwick of Asset-Based Lending. Thank you, Michael, for being here.
Yeah, thanks for having me. Yeah,
I'm
it's
excited.
definitely a pleasure. I'm excited. It's been, I mean, I've watched countless episodes, I feel like, and so it's great to
Super
finally
fan.
be. Yeah, I'm a super fan, so yeah, it's great to be here for sure.
I'm excited. A little bit of background. So I'm going to tell the story of how we connected because that meeting literally changed my life. Some guy, and it's funny, I never use LinkedIn. I think I just started getting back on LinkedIn. It's actually Kaylee. It's not even really me on my LinkedIn. And some guy cold messaged me. And we were looking for a loan at the time. I was like, sure. We were just about to buy a building, a 26-unit apartment building.
Yep.
And the guy goes, all right, someone will be in touch. And then there must have been someone in your office.
Yep.
They gave a referral. And me and you got on the phone. And I was like, this guy might be the only bigger real estate nerd than me that I've ever met. And we geeked out. And I was so nervous, though, because what people don't realize as a real estate investor, and guys, this is going to be a super action-packed episode because we can really go high level. And we can speak to real-world experience. The biggest thing with a lender is, are they going to do what they say they're going to do? And Mike, on that first transaction, I don't remember, I was so nervous. It was the biggest deal we had done at the time. It was a 26-unit building in Keene.
We also had a deal prior to that did not go well, and that's why we were very nervous.
We've told that story with Merrimack Valley Credit Union just absolutely porking us at the closing table.
Yeah.
And you were like, nah, like, hey, Michael, I get it. Like, we've done this. We do it all the time. Now looking back, and we've grown so much, and now getting to know you, that was such a relatively small loan. But it was you guys' first deal, I think, in Keene at the time with that company. And there was a lot of betting on both sides. And you were so professional. And we got it over the finish line. And then it was like we just exploded at the same time together. I think we've gone on to do, I was looking at this ahead of the episode. I think we are close to, if not over, $30 million in loans together.
Yep.
And successful full cycle, well over 10 deals at this point. I mean, millions of dollars in transaction, true value add multifamily. You're just the fucking man, and I love working with you. So you can tell your wife, you can
Tell my
sound
wife.
clip that.
The first thing I was going to say. You can tell my wife. I'll give you her number.
Give the people a little bit because you've been in this space for years. Give them a little bit of your background and kind of how you got involved in the lending space.
So I came out of college and I really focused on institutional real estate.
What does that mean? Because let's not pretend our listeners.
What I would say is that's like apartment community underwriting apartment units between say 200 and say 500 units, you know, in that on average. Some smaller projects, 125, 150, but primarily the 200 to 300 unit space. And I got to know the numbers. I got to really like get trained on how to look at real estate, the numbers, cash flow, how to value real estate, in all different approaches, understand like the market dynamics. I mean, for me, you know, 2 weeks, 3 weeks into underwriting, I'm doing a tax credit deal. It's 225 units in Houston, where, you know, it just had been developed. It was coming off of it was just stabilized, and we were moving into permanent debt. And I was writing a 40-page narrative, and on every aspect, the market, the submarket, and it really, for me, coming out of the gate in the institutional space, like dissected all the different aspects of real estate. It got me into different markets, and then from there, I started to want to like get more and more towards the ownership side of the house. I really always loved, you know, the vision, the development, the, you know, portfolio building. I always wanted to be on the ownership side because, you know, I got into this space really because of somebody that I really wanted to emulate. I think they own about 30,000 apartment units.
Oh, that's it.
Yeah. And I was lucky enough to play golf with him for a couple of years in the summers and really got to know him, and I started to look up to him, and and that's a whole different story. But so always, and eventually I did. I spent about 15 years with a group out of Rhode Island that, you know, I started managing their debt portfolio. We had about $2 billion in debt. We had 50 hotels, a couple thousand apartment units. I was just doing development. I was doing acquisitions. And I really started to really get going with it. They started to trust me. I was doing a lot of the analytical work that they would use to buy hotels and to finance hotels. So it kind of just was easy for me to sort of dig in. And so when the financial crisis hit like peak, and I mean like March 2009, I would say, to like March 2010, where people were really nervous. My CEO, Jim Prakashani, who I really look up to was like a Warren Buffett like guy. And he said, listen, let's be greedy when others are fearful. And said, I want you to go out and buy 1,000 houses out in California. And I said, well, we're in Rhode Island. First of all, how are we going to do that? But second of all, like, you don't just go out and buy 1,000 scattered site houses without having a plan. And so I convinced them to sort of stay close to home. And we went in with 2 feet into buying single family houses. And we could buy as many as we could literally, raise capital for. And luckily, it was a real rich family and with several private equity and hedge fund relationships where we were able to raise capital. We were able to pull it together and eventually just buy houses. I mean, I was buying 15 to 25 houses a month at one point.
I love this story. You've told me before.
Yeah.
It's like you were literally buying these just large, I think it was in Florida is where you guys ended up,
Yeah,
right?
so we were buying, so it's such a different time. We were buying literally as many as we could. It was, so there would be times where I would have 50 contracts out. There would be 30 short sale contracts that would be lingering. There'd be 20 REO contracts. And we'd be trying to put as many in the pipeline as we could. And then meanwhile, while I was doing that, I was building out a team that was forming a brokerage business and a property management business simultaneously. So
Yeah, can I jump in there? Because that's a great question. Because what I want people to understand is you were buying these 50 houses, you're helping this, but the plan was to manage them and rent them with an eye towards an exit at some point in the future. Was
That's
it
right.
5 years, 7 years, 10-year hold? What were we thinking?
That's right. I mean, we were looking, 5 to 7 year hold. We were looking at it from both a cash flow yield perspective. But again, remember, we were coming in saying, let's buy 1,000 houses. I was working for a company that had $2 billion in real estate. So you can't just be a small little operation on the side. You have to take up time in a boardroom talking about a strategy. You have to execute and scale. So we were on our way to 1,000 houses. There's nothing stopping us from getting there. It was about if, not, or maybe when, not if. And so what we were doing was, as we were acquiring, we were getting licensed to sell and in effect, and also buy real estate on our behalf and build a brokerage presence in each of the markets we're in so that we could, as we're acquiring, be overseeing construction and renovation and property management and lease up with a group in place that was captive to us on the ground that could oversee, the strategy all the way to the point where a few years of renting goes by, and then we exit. So we were a burst strategy on steroids,
Like,
and that's
on-
why,
on
like,
scale.
I guess so.
on
Yeah.
super. So, and then in the burst strategy was this: we would buy through a vehicle that we created with a credit union in Rhode Island, and we would literally go out and buy it. We'd put it on the line. We would have capital raised, but we would basically borrow at, say, 70, 75 cents on every dollar we put out. We were getting at very, very low rates. We would ramp it up with a credit union, and then we would take it all out with another bank that had a permanent debt vehicle. So buy, renovate, we would stabilize it with a tenant. We would refi in bulk. So we would move literally a portfolio of, say, 5 million over. 7 million over. And we got to the point where we were moving. And ultimately, long story long, we decided as we were competing to buy more houses that it was going to be better to lend to the folks that I was losing out at auctions or, just on a general REO purchase because they were backed by hard money lenders. We knew at that point the only way to scale and really grow in size was to sort of take what we had built, use it as a credit risk like mitigator because we had the backstop if we ever had to foreclose. And then we went out and built a company called MCAP that was out, in the market lending, raising capital around the fact that if we ever had to take a property back through foreclosure, we have absolutely covered the market with regards to construction, property management, and nobody better at maximizing the value than us as a backstop. So capital started to come in and flow. We started to take our eyes off the ownership side because the debt side was starting to scale faster, and we started to really scale. And I eventually grew the business to being backed by $100 million facility from Goldman Sachs. I left MCAP when COVID hit because our company, the core business was hospitality. So when that goes down, first of all, we always viewed ourselves as that, that company, a canary in the coal mine, because if the hospitality world turns, you realize the consumer's weakened a little bit. So maybe that's going to trickle down to the rest of the market.
You're going to start hitting everything else.
Right.
Yeah.
So we started to hoard cash before COVID hit. We thought we were geniuses when COVID hit. And then the residential market started to take off and get stronger and stronger. Mm-hmm. And I left to join asset-based lending soon thereafter, because we had the vision to lend through it and to see the strength in the market and to take it as an opportunity to get market share and grow, whereas other lenders were hoarding cash. And quite honestly, that's how I was able to meet you guys.
Literally, I mean, just
we're like
there's a lot there to unpack, which is why I was excited to kind of geek out on this. Because one thing we've talked about, and if you guys get any big takeaway out of this, it always pays to be the bank. Remember that. Write that down. You want to be the bank.
Right.
And the thing that I think is important is you coming in. We actually got connected right around COVID. Mm-hmm. I tell people this all the time, and I know you can speak to this. I deal most as a company, but I know you're dealing with it more and more now. These lender relationships are vital. And I try to tell people all the time, loan brokers are A players on your team. If you do not have great relationship with lenders, you will not be in this business long. What is some advice? I'm gonna two-part this. What is some advice you would give to a newer real estate investor going for his first hard money loan? So they're coming to you, they're new, they're green. Second piece is, what is something you want? Because I have my thoughts I'll follow up with. I'm sure Matt does too. What is something you want to see from an experienced borrower that you're constantly like, why would you guys present it that way? It's so stupid, it makes it harder. Those are the two questions I'll throw to you.
So first off, I want to talk about lender relationships, right? I started in this business right after 9/11. I got a job because of 9/11, and that's a whole nother story, but it was a positive in one way and it was horrible in the other way. But it was, for us, it was a workout. For a while, lenders were in workout mode. So I got to see that. I got to see the workout mode from the ownership side after the financial crisis. So a couple things, when you go through that, you learn that lenders value relationships too. And when you go through situations where you're in a workout, nobody wants to be there and nobody expects to be there. But when you come at it from the view of a partnership, because of the strength of the relationship, things like that go a lot smoother and you work through things. Opportunities are created through lender partnerships. And that's really what I think is overlooked a lot. And it's until you go in through tough times is when you know how deep your relationship is with your lender. And luckily for a while, we haven't had to deal with any of that. Values have continued to go up. But I would say those are the times we hope they never come, but they end up coming, and that's an important thing. The second thing is, it's funny because I love the fact that it's all about bet on yourself, and I wanted to present it because I come really from an entrepreneurial mindset. I think we meet because I'm looking for folks like you who are betting on yourself, and to me, I get the beauty of sort of investing my time, and hopefully a lot of Mike Ketchens and Matt Hitchcocks and who understand how to scale and that can use that different ways and see how to unlock value. So we're really investing in you guys, just like you're investing in us. So it's mutual that way. And so the other question, sorry, because
no, that's okay. I want to say the other thing that was getting an experienced borrower. What's one thing, a tip you'd recommend on how they present themselves for the loan? Yeah.
So, right now in my space, it's all about on title or on permit experience, right? So I like to give, there's a certain deal size where I'll want to give a little bit more color on a borrower's resume, whether it be their profession. Okay, I'm in real estate, I'm a licensed this, I'm a licensed that. If you're a licensed contractor, wonderful, and you're looking for a construction loan, I want to know all of that. Mm-hmm. But for us as an industry, and it kind of makes sense, and I actually saw it on your board, we trust the information and then we verify. And what we've moved to as an industry is we're verifying on title experience and we're verifying on permit experience now, at least at asset-based lending. So the beauty of that is at the end of the day, we're going to say, hey, okay, we're going to give you, you're going to fill out an experience worksheet. It's a schedule of all the work that you've done. Mm-hmm. We're going to assess it. And if you have 5 experience in the last 3 years, that's exited deals. It could be a full burr and a refi. It could be a sell. It could be a GC doing a project that's similar and pulls a permit in their name, we're going to give you credit for that. We're going to count them up, and your rate is going to improve as you verify more experience. So I would say that, certain things we like to know. It's nice to know. If you have specific experience in what you're doing, GC experience, licensed contractor, you're a licensed real estate agent, managing properties, you're mitigating risk in the loan. We want to know that. But ultimately, it's going to come down to counting experience, verifying it, and then rewarding that experience with lower rates and higher leverage.
So to be clear, if you haven't done a deal, it's not that you guys will say no. And this is something that you all should hear out there if you're looking to do your first flip, right? Remember when we first got started? We've told a story. What do we pay your parents on interest, their first loan?
Oh, 15%.
15%.
Which was on steroids because we actually paid it within 4 or 6 months or something like that.
We were so stupid.
Yeah. So
we didn't realize
so that ended
that.
up being like a 40% return.
Mike, we gave them the whole annualized return because we didn't know what an annual return was.
Right.
So they made 45. You've never seen people so happy to write a check again.
Yes, of course.
In their life.
Of course. You won them over right away.
But so you knew, and this is what always kills me is I call them spreadsheet wizards, right? It's like you guys got to get off the sheets and you got to get in the streets.
Right.
If you're doing a good enough deal, there's two things you can do that I want to unpack that Mike just said. One, you might pay a little bit of a premium, but I also talk to people all the time about velocity of capital. You guys are going to include the rehab funds.
That's right.
Second off, and most important, if you're not comfortable with the higher rate, go back to what the thing Mike just said when you're listening to this. You can partner with someone, give up a piece of the pie, but borrow their experience and their mentorship. And I believe, and I'll let you speak to it, in a lender's eyes, that's going to make the lender a lot more comfortable. If you do a multifamily deal with Commonwealth Collective versus you've never done one, asset-based lending is going to be a hell of a lot more comfortable with us on the loan. Am I? You can speak to that a little bit, Mike?
Yeah, because it's really common sense if you think about it. I mean, the more experience you have, the less risk we feel we have in making the loan. So we reward that. So if you're an investor that doesn't have experience, let's say on a 1 to 4 unit, your rate might be 11.25 and 2 points. So that's 11.25% interest only for the time that you borrow on the outstanding balance, not the construction escrow maybe that's unfunded. So you got to all things, and then 2 points on the full loan amount. Right. So then when you add experience into the mix and now you partner with Mike Ketchen, you're bringing his experience to the table. We're looking at our risk now and we're saying, look at all the round trips he's done. All you need is 5 or more with us. We're going to reward that. And we're going to say, okay, now you get a rate of 8.99% and say 1.25 points, or you might be 9.5 and 1. And you have all these different options that come into play. Now, so your deal gets done, we'll close your loan and we'll grow with you. That's how we really have built the business. I mean, a lot of first timers, but to attach yourself to an experienced, investor like you guys are, you're going to get the benefit of all the savings and interest, the point savings. You're going to have less down, which means you have to raise less equity, that you're paying whatever 20%, whatever the numbers are. So when you start to factor that in, experience is going to, just really, I mean, it's going to matter dramatically on the profitability of the deal. It's going to instantly approve the deal. It's going to make it a lot smoother, but it's not quite necessary.
And that's what I really wanted to have takeaway as we know. Do you have something you want to jump in with?
No, I was just going to say that, I mean, to your point, kind of professionalizing things, I think that was one thing that we didn't do when we first started. We didn't document all the nuances and things and kind of professionalize a portfolio as we went. We were just in the weeds of just trying to figure it out.
Of course.
So I think in terms of like what I would say is just people kind of writing down and making sure they're documenting things. Because when you talk to a Mike, for example, when you're talking to someone that's lending you the money, you want to make sure that you're giving them a professional presentation, essentially.
Oh yeah, that's a great tip.
Because we tried to freestyle. Remember Merrimack? We tried freestyling that one. Yeah. And we were just pulling off random stuff online, and we were like, we know it's a good deal, but this is that, and like we just kind of freestyled.
Didn't know. And one thing we learned early on with that again Mike can speak to is the way I try to explain it to, especially when people are new. The less questions the lender has to provide the answer to, the easier the transaction. And what I mean by that, and it goes back to Matt's point, give them a market summary. Give them a pro forma, how you think the building is going to do. Tell them, this is the $1 million tip. If you are in real estate, it fucking kills me that no one pays attention to this. Have your exit strategies before you buy the building. Tell the acquisition lender your exit strategies. they will thank you. Mike, am I lying? It's a number one thing. How am I getting paid back?
Yeah, that's
all they care about.
Yeah, speak to that.
It's always a reverse engineering of the numbers. It starts at the end. What do I see for this property after, I do this? Okay, well, what does that cost? Okay, what do I need to buy it for based on what it's going to cost me to get it into the after repair value that we're looking at? And ultimately, you're reverse engineering all the way back down. And it's just, we want to know that there's an exit strategy. And I'll even, if a borrower's credit is borderline, I'll even steer a borrower towards making sure that they're really pushing to sell the property, even though their intention is to improve their credit and exit via refi. The conversation with the underwriter might go smoother if they talk about the exit being the sale versus a refi. So the focus is always, how are we going to get out of that loan? We're making 12-month loans here.
Yeah.
They're meant for you to get in and out of deals. We know that. You know that. It's speed of money.
Yep.
So exit is key. Exit's everything.
100%.
And then it goes back, can you execute it? Do you have
and as you can
that?
tell, what make Mike different, and that's why I can't have a bigger ringing endorsement than literally having you on the show or putting a name on it and have done how many transactions we have, is what he just said right there. He is truly in your corner. He's going to bat with you. He's having those little conversations that the average borrower isn't aware of. Is that, remember, it's the loan officer's job to say yes. It's the underwriter's job to say no. And they have to figure out a way to get it over there. And the more ammunition you give the loan broker and the stronger he believes in your business plan and how you present the information, the more success you're going to have. Which that is a perfect segue to ask, what are you seeing? Because me and Matt are aggressively buying right now. Mm-hmm. I believe this is the 08 opportunity for multifamily. What I mean by that is, it is not 08 in the terms of the economy is just different. With multifamily, though, there's multiple distressed deals. We've bought a couple of bank foreclosure. We're about to do another bank foreclosure. Huge deal with you. We'll announce when we go under, which actually I think I just got an email. I think we are under, but we'll talk about that.
Nice.
We think it's a great buying opportunity. We are back to what you said, your mentor said. We believe right now is the time to be greedy. I think we have about a 12-month runway. Trump is fucking up our plan. He's trying to demand rate cuts, which is going to make, we do not want those rate cuts yet. What are you seeing on the lending side right now? Because I remember over COVID, we had so many conversations. Initially, there was fear.
Yeah.
Then there was a big party. Then I think like 23 rates started to rip. Exit started to get tricky.
Yeah.
You guys started to pull back a little bit because you anticipate that. Remember, it was hard. I said, you gave me a heads up. You're like, hey, it's just changing with us internally.
Yeah.
What are you guys seeing right now internally? What do you think about the market as someone who's very seasoned?
I mean, I think we had a stake and talked about a stake at Del Frisco's and talked about the distressed opportunity. And that's, to me, again, just to reiterate, this is why it's important to have strong lender relationships, because if you do, you're going to be able to get deals done in down markets because you're a trusted borrower that has exits, right? So when you're coming to us with a multifamily deal in a market that's somewhat depressed, you got to be really special to be able to get deals through. Like, for example,
can I go a little inside baseball?
Yeah,
I'm going to say this. So I'm just going to tell the story because I can go to the speech of the relationship. So me, Mike, and the CEO of ABL, I don't know.
Kevin Rodman.
I don't want to put him out there. Now.
Yeah.
Kevin Rodman. Yeah. We go out to dinner, and Kevin had come up to meet with me and a couple of their bigger borrowers, and I ran this by him. And you guys took a chance on us. I don't even know if Matt and Hannah know this story. They were not lending in Ohio. They were not lending on large multifamily. They're not lending in Missouri, and they're not lending on large multifamily. Yeah. And they did both of them for us.
Right.
And Kevin said, basically, you've shown to us, we believe in you and your team.
Yeah.
And they basically invented a product for us.
The jockey, not the horse.
Yeah.
Exactly. And we went to dinner. We did over dinner, and that has translated, just so everyone's aware, to talk some real numbers. That is close to probably 300 units now outside of New Hampshire that we've done deals with ABL on, and over $20 million in loans from that relationship. And again, betting on the jockey, not the horse. So that's what I mean. He truly means what he says when he says this right here. You know.
Yeah.
So continue on, Mike. With the sentiment there.
So it's important. I mean, and so it's always it's for me. I like to highlight that. But now let's talk about the markets. Yeah. I mean, the multifamily space has taken down some of our competitors when they were pulling back. It's because they're having problems with borrowers exiting. Right, we just talked about it. They can't get now all of a sudden they're extending more loans. So it starts off with, okay, lender's taking a little bit too long to get us out of this. We need an extension loan. Fine, you extend. Well, the lender's not there anymore. We need to go find another lender because that exit didn't happen. Yeah. And then you start to build up a portfolio of exposure. And then now if you don't pay, and now you start to tighten up and you start to worry, and that's what happens. And it's definitely happening. It's also it's unfortunate, but it's also an opportunity for folks like us, right? So we don't have those types of problems in our portfolio, so we can go out and lend and make loans and to trustworthy borrowers like yourself and grow and take risks. And I don't think we've ever made a loan in Kansas City. And there we
You guys
were.
did it.
Yeah, so those are good. But to me, I love this. We've talked about it since we started our relationship. You need to be buying and taking advantage of opportunities in distressed markets. That's where the money is made. You're buying it right. I've seen it time and time again now. This will be my 4th cycle if it does continue to play out this way. So I don't know. I hope, it's going to be fun to watch you guys grow your portfolio.
Oh, so and you're going to be a vital part of it. Before we get you out of here, where can people get in touch with you and learn more about you?
At Mike Chadwick Jr. for Junior on YouTube. I'm trying to grow my channel, so please subscribe.
Yeah, like and subscribe, a follow. You definitely got to give. Let's see Instagram because you're doing a lot on there now.
Same thing at Mike Chadwick Jr. for Junior. Same thing there, and then ABL funding, asset-based lending. We got great programs. Don't hesitate to reach out anytime via social media for sure.
You want to know who Michael Ketchen's lenders are? You're looking at one of them. Hit up Mike. As always, he's Matthew Hitchcock. I'm Michael Ketchen. And bet on yourself.